Great. Thank you, Jason. Hopefully we won't have a train wreck tonight. Tonight I'm going to talk about what happened last year in the investment markets and what has happened so far year to date. We're going to look at our forecast for the economy in this year and beyond, namely employment and the housing market. We feel these are the two sectors you have to watch in the coming year. We're going to look at some opportunities and threats we see in the market to that forecast, and finally some ideas on investment strategies in the current environment. So now looking at the markets last year, U.S. equity markets very strong last year. S&P was up 16%, and it has continued on this year, year to date, up just over 10%. So very strong U.S. equity markets. Canada, not bad, but not quite as strong. You can see last year, markets up just over 7%, and so far year to date, just up over 3%. So again, not a bad return, but not as strong as what we've seen in the U.S. Looking at the bond market, tonight I'm only going to look at the 10-year bonds. Nothing much happening in short-term bonds. With the interest rate policy hovering around 0%, all the action has been further out in the curve. Now we're showing 10-year Canadian bonds in white, U.S. 10-year bonds in yellow, and I throw in the 2% yield as a line because anytime you're trading below 2%, it usually indicates the financial markets are in sort of a crisis mode. And you can see that rates have, for most of last year, been well below that and have been pretty steady at around 1.7, 1.8%. However, year to date and at the end of last year and beginning of this year, we've seen interest rates increase. And we think that's mainly because we're seeing a stronger economy. The other thing I would highlight with these interest rates is that last year, Canadian rates were typically higher than U.S. rates, and we've seen that reverse. And now Canadian rates are lower. And we think that's also indicative of the strength we're seeing in the U.S. economy versus the U.S. or the Canadian economy, seeing a stronger U.S. economy. Now, having said that and trying to get a bearing on the economy, and we think the interest rates are going up and we think things are getting better, what happens? The bond yields turn down. I mean, that's typical of the economy. It's giving us conflicting messages, and it's very hard to tell if the forecast is good and bad. And it reminds me of a website on the Vancouver real estate market called Crack Shack or Mansion. Now, you can go to this website, and it'll show a picture of a house, and you have to judge, is this a mansion? In other words, did it sell for over $1 million, or is it a certified crack shack? And if you look at these two homes, they both look the same. They both look like they could be a crack shack, quite frankly. The one on the left actually sold for almost $1.8 million, whereas the one on the right was indeed a certified crack shack. Now, the advantage with this website versus looking at the economy is they tell you the answer. And tonight we're going to do that as well, and we're going to use this terminology. When we think the attribute of the economy is positive, we're going to say it's we're going to be a little bit more clear, though, when we show it, because when we have something we think is a crack shack, rather than show a house like this, we're going to show something that's really bad. So there's no disputing that it's a bad thing and it's a crack shack. When we think something is good, we're going to show a nice-looking home. When we think something in the economy is really good, we're going to show a real mansion. So now let's look at the economy, starting with the U.S. labor market, the employment market. And these bars are showing the monthly growth in new jobs in the U.S. And you can see typically in the U.S., they need about 125,000 new jobs every month just to keep up with population growth. About 200,000 jobs, and you actually have a growth in the labor market or a declining unemployment rate. You can see that last 5 months, we've been well above that 200,000 mark. In fact, only January did we dip below that. So we've had some very good numbers coming out lately and above the 200,000 mark. Why this is significant, why it is good is, as Bill Gross would point out, 200,000 jobs growth a month typically equates to about a 3% GDP growth. That's not great, but it's certainly better than what we've been seeing, and is giving us confidence that the U.S. economy is indeed recovering. Now, one of the things you wonder about is where are all the new jobs going to come from? And another thing that gives us a lot more confidence about the U.S. economy is something called the manufacturing renaissance. And in the U.S., because of cheap oil and a lot of new shale gas, energy prices have come down. Companies are starting to reshore their manufacturing into North America, such that Boston Consulting believes that the manufacturing renaissance could add up to 5 million jobs by the end of the decade. So that, again, is very encouraging. But it's not all good news, unfortunately, on the labor front in the U.S., because the recovery, while we're finally starting to see signs of it, there's also some weakness, and it's been an incredibly slow recovery. In fact, if you look at the past 11 recessions since the end of World War II, this has been the most sluggish recovery on record. Typically, it takes about 24 months to recover all the jobs lost in a recession. Even after 60 months, we're still down about 3%. At this point in the cycle, after 60 months, we should have growth of about 6.5%. The other thing that's very slow in this market is how long it's taking people to find jobs. Typically, people take about 15 weeks to find a job when they lose their job and become unemployed. It's been upwards of 40 weeks and presently around 35 weeks. This is significant because the longer someone's unemployed, typically when they do find a job, usually at a lower rate. In fact, for every year of unemployment, you can deduct about 11% off the final pay versus what they were getting before. So this is, again, a very negative attribute we're seeing in the labor market in the U.S. What is also worrisome is wage growth. And this line here is showing private wage growth in the U.S. And you can see if we were to plot out the inflation rate, it's barely above inflation. So people, again, wages are not going up very high. Now, this is good for inflation because it's hard to see how you can generate inflation in the U.S. with this kind of wage growth, but it does also put pressure on consumer spending. Now let's look at Canada, quite a different story, because if you look at the blue line, it's Canadian labor growth. And you can see that Canada, that line going across, indicates that Canada actually recovered all the jobs lost in the recession by January of 2011, versus, as we mentioned with the US, they still haven't reached that peak. So in Canada, quite a strong recovery, and Canada continues to add a lot of jobs every month. So quite a different story than we've seen in the US, and Canada actually globally has been one of the best countries as far as the economic recovery goes. It's not all good news in Canada either, though. I would point out there is some risk. Hanson Advisors estimates that about 7% of our labor force is related to the housing market, and about 1.3 million people. We don't think we're going to have a US-style housing crash, but if we were to, you'd lose almost 400,000 jobs. So that's something to keep in mind with the Canadian labor market. So how do we score employment as far as the economic forecast goes? US, we would say a respectable-looking house. I mean, it's early days yet, but we're seeing some positive signs in the labor market. As far as Canada goes, there are some risks, but you cannot argue with the labor growth we've seen and the new job creation in Canada. It's very positive. Now let's look at the housing market itself. US, this is existing home sales, and you can see the line is starting to move higher. And you've seen in January existing home sales up 9% year over year, median prices up 12%. That's very encouraging. But what makes us even more excited is that the inventory of unsold homes is only 4.2 months. What this means is that at present sales trends, it would take only 4 months to clear all of the homes available for sale in the US. Typically, a balanced market is about 6 months. What does this mean? It means the US needs to build more homes. And that's starting to happen. January, you saw housing starts at an annualized 900,000 homes. That's up 24% over last year. Same thing for building permits, up 35%. At the peak of the housing market in the US built 2.4 million homes. It's estimated that population growth alone dictates the US needs about 1.8 million homes a year. So we could double the construction from present levels, and you're just meeting population growth. So we see a lot more growth in the housing market in the US. Why this is important is you look, during the financial crisis and the recession, Goldman Sachs estimates that the housing bust cost GDP growth about 2.5%. They estimate that this year, the housing sector and construction should add about 0.5% to GDP. And they're conservative because Deutsche Bank thinks it could be 2%. So again, very positive for economic growth, and we think the US housing market is going to be a major driver of economic growth in the US. And one of the things where you're seeing that transpire is in consumer spending and lending. And you know, if your house is going up in value, you feel wealthier and you spend more. And we're seeing this now with the U.S. consumer. They're starting to borrow more money. In fact, in the fourth quarter of last year, loan growth in the U.S. went up 0.1%. Now, that's not a lot, but it's the first increase since the financial crisis, and it makes us think that the consumer has run through their deleveraging cycle, and are now ready to start consuming again. And again, with the U.S. consumer at 70% of U.S. GDP, that's a significant factor. Two areas were particularly good were credit card growth and auto loans. Now, looking at the Canadian labor market, I think, and David's going to talk a bit about this as well, I mean, everyone's worried that we're going to have a housing bubble burst, and we don't see that, but we do see some headwinds. January housing sales in Canada were off 5%, and prices up 2%. So we're seeing a fairly balanced market, as we can see with the number of inventory of homes for sale in Canada. So we're not seeing that bursting, we're seeing a slowing. And we don't think you're actually going to see a dramatic fall in prices. But even in Vancouver, where we definitely think there's a bubble, you can see sales are down 14%, but prices are only down about 3% and only 6% from their peak. So again, we don't see a dramatic fall off in the housing market happening right now. But what we are concerned about is the opposite of what you're seeing in the U.S., which is housing starts and construction is turning down. You can see the blue line is Canada, red line is U.S. You're seeing construction and housing starts fall off in January, down almost 20%, building permits down 16%. And so this is a headwind for economic growth in Canada. Again, Hansen Advisors points out that the housing sector has contributed about 27% of the Canadian economy last year. The U.S., at the peak of their housing bubble, only contributed 24%. About 44% of Canadian GDP growth since 2005 has come from the housing market. So if this slows, it's obviously going to impact our economic growth. And that's eventually going to transpire into retail sales, which in January was down 0.1%, and we think that that's going to happen more and frequently in the future, which is, quite frankly, is not a bad thing because Canadians need to deleverage, as we've been hearing from our finance minister and the Bank of Canada. So how do we score the housing market for the economy? Again, U.S., I would even upgrade that to a real mention. We're that positive about the housing market. We're seeing definitely trends of an increase. Canada is a crack shack. And even, we don't think it's going to be, again, a housing bubble bursting, but we do think it's going to be a headwind for the economy.